The Fed just froze rates. The dollar is sliding. Gold is ripping. Housing refuses to crash. And everyone on Wall Street is acting like this is totally normal. It's not. This isn't about today's decision. This is about a bomb that gets wired for May 2026. And your money is standing right next to it. Welcome back to the comment section with Thomas Paul, where we read between the lines of press conferences so you don't get wrecked 6 months later. Here's the setup. The Fed looked at slowing job growth, sticky inflation, an election season circus, and basically said, yeah, we're just going to sit here. No rate cuts, no hikes, just a freeze. On paper, that sounds boring. In real life, markets went full drama. Stocks near record highs, gold and other hard assets jumping, the dollar losing strength, housing still stupidly expensive. It's like the economy's throwing 4 different parties in 4 different houses, and you're invited to all of them with the same paycheck. Here's where things get interesting. Underneath that calm, data-dependent Fed language, everyone knows the real clock, May 2026. That's when Jerome Powell's term ends. And markets are already trading like they care more about the next Fed chair than the current one. You've got Trump pushing hard for much lower rates, publicly talking about levels around 1% and praising the old Greenspan days, the era where money was cheap, bubbles inflated, and everyone pretended it would never end. Meanwhile, Powell is trying to look independent while also getting hit with DOJ subpoenas over a Fed building renovation, which he says is political pressure. So now you have a central bank saying, we're not cutting yet, a president saying, cut more and faster, and a market saying, tell me who's in the chair in 2026 so I can front run it. But it's even getting worse because the data doesn't match the vibes. On one side, the bulls say, AI is boosting productivity. Big companies are minting profits, and wealthy households are still spending like nothing's wrong. They're betting this freeze is just a pause before a gentle glide into lower rates, more growth, and higher stock prices. On the other side, the bears are looking at a softening job market, a dollar that's being weakened by years of money printing and deficits, and geopolitical tension everywhere. They're not predicting some gentle glide. They're saying, when something finally breaks, this whole everything bubble can reset fast. And here's where things take a step further. Almost every major forecast you see right now expects this year to be positive for stocks. Some say single-digit gains, some say big upside, but basically nobody is putting a negative year on the front page. Historically, when the consensus says, don't worry, it'll be fine, that's when you should at least start checking where the exits are. Housing is the clearest example of this fake calm. Pending home sales have dropped to levels we haven't seen since the 2020 mess. Not in one region, across the board. Realtors keep blaming low inventory, like there's some magical shortage of houses that just happened by accident. In reality, it's a standoff. The people who absolutely had to buy already bought. The rest are on the sidelines waiting for rates to fall. Sellers? They're locked into cheap mortgages and staring at Zillow screenshots from 2022 like it's their retirement plan. Nobody wants to cut prices. Nobody wants to move. So the market just freezes. But then the unbelievable thing happened. We got policy ideas thrown at this mess. For example, that big proposal to inject about $200 billion into the mortgage market to nudge rates down. And yeah, for a minute, rates dipped. Everyone got excited. Then the math kicked in. The mortgage market is tens of trillions of dollars. $200 billion is a Band-Aid on a broken leg. Even if you push rates down a bit, cheaper mortgages usually mean higher home prices. Whatever you save on interest, the seller happily takes on the sale price. Affordability doesn't magically fix itself. It just shifts where the pain shows up. So people ask, okay, what if we just stop Wall Street from buying single-family homes? Sounds bold. Except institutions still own a relatively small share of total housing. Even if you kicked every big investor out tomorrow, you still have low supply, locked-in owners with 3% mortgages, and the Fed sitting on trillions in mortgage bonds. So the more extreme the policy headline, the smaller the actual impact. Unless we see some massive housing bailout or serious tax changes, the most likely outcome is boring and painful. 2026 looks a lot like today. Slow sales, sticky prices, buyers angry, sellers stubborn. But then he said this unbelievable thing. Powell, in his calm central banker way, basically told markets, "We're watching the data, we're not promising cuts, and we're not reacting to political pressure." Translation: don't expect a hero move before 2026 just because the election cycle is loud. At the same time, Trump keeps reminding everyone how much he liked those ultra-low Greenspan era rates, the same environment that helped inflate a massive bubble before it burst. Put that together and you get this weird, dangerous mix. A present that's fine for now, and a future that might be all gas, no brakes. So investors are doing something very human. They're hedging. Money is still flowing into AI stocks and high-flying tech, but you're also seeing a clear move into gold and other real assets. People want upside, but they also want something that doesn't vanish if the next Fed chair decides to step on the accelerator and wreck the dollar in the process. In terms of how I plan to invest, I'm going to spell this out, because when I was 12, my parents trusted a bank advisor, didn't really ask questions, and watched their savings quietly bleed out. No crash on CNBC, no dramatic movie scene, just a very quiet dinner table for a very long time. That's when I learned, if you don't have a plan, someone else's plan uses your money. So here's the simple framework that actually survives this kind of chaos. Number 1, accept that expensive markets can get more expensive. History shows they don't crash because valuations are high. They crash when something breaks. Jobs, credit, the banking system, the currency. Until then, FOMO can run longer than your patience. Number 2, don't be the person who has to sell. High-interest debt is the enemy here. If you're juggling 20% credit card balances while speculating on meme coins, you are volunteering to be the first casualty when volatility spikes. Number 3, keep dry powder. That just means some cash or very safe assets. So if we get a sharp drop, you're the one buying, not panicking. You don't need to nail the bottom. You just need to still be standing. And number 4, diversify in plain English. That might mean some broad stock exposure, maybe some dividend payers, maybe a bit of gold or other hard assets, maybe a fixed-rate mortgage locked in at a decent rate if you're already in housing. Boring, spread-out bets beat all in on the hot thing almost every time. So in terms of my own plan for investing in this kind of Fed freeze and weak dollar environment, here's what I think. I lean toward quality over hype, cash over leverage, and time in the market over trying to guess the exact week Powell walks out and the new chair walks in. Quick note before we wrap. This entire channel, including this video, runs on fludge.io. If you're watching this thinking, I'd love to talk about markets or politics on YouTube, but I don't want to be on camera, and I definitely don't want to edit. That's literally what this system is built for. It researches topics, writes scripts, creates thumbnails, uses an AI avatar, and uploads for you. You stay in control, approve what goes out, and over time it learns your style. It's not low-effort spam. If it was, you wouldn't still be here listening to this. If that sounds interesting, check out fludge.io. And here's the last piece. None of this is personal financial advice. I don't know your situation. I'm giving you a way to think about the mess, not a shopping list of stocks. So, your turn. Do you think the big risk is the dollar breaking, housing finally cracking, or an AI-fueled bubble blowing even bigger before it pops? Drop your take in the comments. I actually read them. And tell me how you're positioning for this Fed freeze. If you found this helpful, hit subscribe, tap like so more people see it, and I'll see you in the next episode of the comment section with Thomas Paul.